Guys, welcome to Foundations of Real Estate Financial Modeling. Today we're going to go over the concept of weighted average cost of capital, its formula, and a sample problem to wrap it all up. So the weighted average cost of capital, what it is just as it sounds. It's the average cost of capital that a firm incurs from debt and equity instruments. And what this is used for is basically in a real estate project, you usually have two main sources of capital. So you have debt and equity, and there's a cost of debt and a cost of equity associated with using your own equity, using somebody else's equity, or taking out a loan from a bank. The cost for debt would be the interest rate that a bank would charge you. And if you're using your own equity, the cost would be the opportunity cost of taking that money and investing it somewhere else. If you're using an equity partners usually have, they charge you an interest rate on it as well. So they'll charge you an interest on it just like a bank. So the weighted average cost of capital, it's useful because you can use it as your discount rate to determine the net present value of your cash flows that are going to be generated by a real estate project, right? And this is also useful because the weighted average cost of capital can be used as the benchmark for the minimum required rate of return. And what this means, and it makes perfect sense, right? Because if it's costing you more to get capital than what you're actually going to make, then that means you're going to lose money, right? So if your weighted average cost of capital is 10% and your internal rate of return is only 6%, then that means that your costs are higher than your returns. So that wouldn't be a good project to jump into. And vice versa would be true as well. If your weighted average cost of capital is 10%, but your internal rate of return is at 15%, then you're in good shape. It's a sign of a healthy project. So this is how we calculate it, guys. This is the formula where E is the amount of equity we're going to be using. V equals to the total value of the capital for the project. RE is the cost of capital plus debt divided by the overall value of capital in the project times the cost of debt times 1 minus the corporate tax. And this section here, this is known as the tax shield. So what this means basically is that you're gonna be paying less in taxes than you otherwise would if you wouldn't have taken any debt. And that's because your interest payments on your debt are tax deductible, so your tax bills, it's lower than if you would have never taken any debt, right? So that's what this part right here is. Okay, so we can jump into a sample problem. As an investor is considering purchasing a 4-unit multifamily project, but he's limited to on capital. The individual has $125,000 and the purchase price is $625,000. The individual has a commitment from a local lender to fund the difference, assume no transaction costs and or inefficiencies. The lender will charge a 6.25% interest, and the investor can earn 11% in the equity market on invested capital. Last year, the investor paid 26.5% in federal taxes. What is the investor's weighted average cost of capital that should be used to discount the forecasted cash flows for the project? Okay, let's jump into it. Okay, so we know that you need to get federal taxes, and we know that the investor paid 26.5 in federal taxes last year, so we can use that as our benchmark. So 26.5. The cost of debt, we know that the lender is charging us 6.25% interest, so that would be our cost of debt. cost of equity. This we know that we can earn 11% in the equity market on this invested capital, so that would be the opportunity cost of using our own equity, and that's 11%. We have $125,000 on equity, so that would be our equity. Debt, we have we have a lender that's committed to fund the difference, so the difference would be the $625,000 that we need to pay minus what we already have, which is $125,000. So we have a debt value of $500,000. Equity plus debt, well, we know that we need the combination of equity plus debt needs to equal to $625K, so we're $625,000. Okay, and now we have all of our values to calculate the WACC. So we have the cost of equity times the amount of equity. It's going to be plus, we have the cost of debt times the amount of debt times 1 minus the corporate tax, and I forgot to divide over here by the total value, which is this. Let's close it in parentheses, and here you got the same thing, the total value of 625, and there we go. So our weighted average cost of capital is 5.88%. And that's how you calculate the weighted average cost of capital, and you would be looking at comparing this value to your internal rate of return or your modified internal rate of return. I'm gonna leave the links to a couple of videos that I made on the internal rate of return and the modified internal rate of return in the description below. You guys can check them out. If you like the video, please like, comment, subscribe, and I'll catch you guys soon. Have a good one.